Hello, everyone, and welcome to this week's Forte Financial Mortgage Group podcast. We have an incredibly special guest this week. We have Noel Gill. Say hello, Noel.
Hey, James. Hello.
Noel is from the Kelly Group. He is a credit expert, and he has been doing this for the last 21 years. And we are so lucky to have him on this show today because there are so many misinformations and lack of understanding that Noel's going to help us clear it all up. What this means to you as a consumer on not just for your mortgage, which we'll get into, but for other things in your life, like getting credit cards, or what effect credit scores actually have on getting a mortgage or car loans or credit cards. And hey, you have a repossession on your credit report. How do you get that off? All these things will be answered in today's episode of Forte Financial Mortgage Group. Noel, say hello.
Hello. Good to be here.
Yeah, no, it's great to have you. So I've known Noel for probably close to the 21 years he's been doing this. The Kelly Group has always been our go-to for credit repair, credit advice. They have helped countless clients of ours get them out of credit issues, no matter what that is, whether it's incorrect information, late payments, on the credit report, you name it, they've helped us. They've been a true asset. And it's time that we share some of that information with you all. There's always so many questions we get on, credit scores and how they work and how they can improve their scores. So let's get right into it. The first topic we're going to discuss is the effects of credit scores on a mortgage and what you can do to fully prepare. So first off, before we get Noel's input here, credit scores are incredibly important on getting a mortgage, depending on the type of mortgage specifically. Like a conventional loan, which is the most traditional loan in that sense, your credit score is extremely important. You really 740 is really, I try to tell people, is the target where you want to get, but even a 760 and above score will get you an even better rate and term on your mortgage. So, Noel, do you want to talk a little bit about, just the credit scores, and we'll start with some basic things that consumers should be preparing themselves for when they're coming to get a mortgage to maximize what those scores may be?
Sure. I mean, the first thing is know what your scores are. A lot of people don't know what your scores are, and they also have no idea what goes into them, what it takes to get your scores raised, and how your scores can sometimes fluctuate, just you not doing anything really, bad, but just watching your score fluctuate, 30, 40 points just over the course of month to month, just by the way maybe you're carrying extra balance in your credit cards, or maybe you opened up a brand new account, or whatever you might be doing. So a lot of times people don't know what goes into that credit score, and really knowing what goes into it is really the first key, because there's no school, they don't teach you about it in school. They don't teach you about after. People like, oh, I pay my bills on time, I think I should have a good score. Well, you probably do, but maybe you don't. Maybe you're like, well, hey, I don't use credit for anything. Then you don't have credit. So there's a lot of things that people do just in every day, and they're kind of almost flying blind. So sometimes people get lucky and you fly blind and you're doing successful, and sometimes you're flying blind and maybe you're doing something completely wrong, or maybe what we find out a lot of times is maybe you're doing something and maybe what you're doing is not the best for your credit, and we try to put you on that right path and see what we could do about trying to help you, increase your credit score.
So one of the things that that's a great intro, Noel. Thank you. One of the things that we see a lot is when people have very high balances to their limit, that we tend to see someone who has never made a late payment, they could have scores well into the 600s, even with no late payments, just because their ratios are high. So tell us about what people should be trying to achieve in terms of credit limit, maybe types of credit, and ratio of balance to limit. How does that all work for that the consumer can look for?
Sure. So the first thing is what they calculate on on your credit cards. Okay, those could be credit cards. Those could be any revolving accounts. Okay, not home equity lines, which are a revolving account if they're over $70,000. But any equity lines that are below that, if you bought furniture, any credit card account you have, with the exception of American Express, what they're calculating is where you carry your credit card balances. And what they're looking for is one of the telltale signs of somebody that's in trouble is when they have high credit card balances. In other words, they're using their credit cards to survive. So they can't tell, the credit score can't tell, hey, are you paying off your balances each month? And then this is just you just living, using it as a convenience, or maybe you're traveling for work, or are you in trouble? So what they do is they're just calculating where your balance is in proportion to your limit. And ideally speaking, you want, in order for you to get your every last point for your score, you want your balances to be less than 10% of your limit. So if your limit is, say, like $12,000 on a credit card, you want your balance to be less than $1,200. Okay, and as you get higher and higher and closer to 100%, you're going to lose more and more points off your score. So one of the big myths I always hear people say, oh, my balances are below 30%. Well, 30% is kind of a confusing number because for your FICO score, your balances count for 30% of your score. It's not where you want to be. You want to be less than 10%. But when you're below 50%, really the real sting of it has really come out. So, you definitely want to be below 50%. If you're at 90%, if you're below 75%, that's going to be a huge difference. If you're below, at 75%, being below 50 is key. And then again, ideally is below 10%.
Awesome. So really under 50% is the first real goal, but the ultimate goal is under 10%. So that's great to know because, even what we do sometimes, Noel, which is really, we'll run our little credit simulators through our credit reports, which will kind of tell the consumer, hey, if you pay this balance down to that or this, you have a potential score increase of X. But, it's not always correct. It's not always perfect. But having that, what you just shared with those percentages makes a lot of sense that we don't even need to do that. We can kind of just use that as a gauge to make it easier. Thank you. That was really good.
And those simulators that you use, sometimes they're not FICO scores. So sometimes when you try to get very sharpshooty with those things, sometimes they're wrong. But because FICO doesn't share their formula, right? That's a secret formula. They're not sharing it with anybody. Mm-hmm. You can get your scores, but you certainly can't. You don't have the access to their formula. So just using those numbers that you just came up with, and that's probably something you see with those people that you're trying to say, hey, if you're above 760, what your people that are at 740s in order to get to 760, that's probably the key is get it below 10%.
Awesome, thank you. And you just brought up the next topic. It are the different scoring models. So many times our consumers come in, hey, well, I just checked my credit score on Credit Karma, and I'm a 720, so I'm good. Yeah. And then they complete the application. We do our soft pull, which is not the same model as Credit Karma, which you'll explain. Yep. And our score is maybe 660, 670, and it's significantly lower. Yep. So can you explain the difference between a Credit Karma score, what some of the different scoring models are, and why a lender like Forte Financial is going to have a different score?
Sure.
That would be awesome.
No problem. So what you see is, there's different scores out there. There's a lot of different scores. And when you're talking about, your Credit Karma score, you're talking about even the scores you might get from your credit card companies. Those are different brands of scoring. Now, Fannie Mae and Freddie Mac dictate on what scores are used for the different mortgages and what they're going to use. So when they're using FICO scores, Fannie Mae and Freddie Mac, with Experian use version 2, with TransUnion use version 4, and with Equifax version 5. Now, when you go to Credit Karma, they're using what's called a Vanta score. Now, there is some talk about maybe trying to introduce the Vanta score down the line, but it hasn't actually come to fruition yet. So that score could be very different. So you can't even say like, oh, you're usually 20 points higher or 30 points lower. They're all over the board. And the FICO 8 scores are, even though it's a FICO score and they're using FICO scores for the for mortgages, what they're actually it's kind of like, me and my brothers. Me and my brothers look similar, right? You can tell we're brothers, but we're very different. And that's that FICO 8 score versus the version 2, version 4, and version 5 across those three bureaus. So they're quite different. So what you probably see is people complain when their score is lower, right? Nobody's going to complain like, oh, I thought I was only a 710. You say I'm a 740, they're not complaining. But what happens a lot of times is you see people that like, hey, I'm on Credit Karma. I know that my score is a 760, and then you pull it and it's a 689, and then they're like, what's going on? Because I know. And they're just very different scores. So a lot of times people aren't aware that those are different scores. So you always have to read the fine print on those scores. It does say that, hey, they're not FICO. FICO is the industry leader. So they're always, there's always disclaimers basically saying, hey, these aren't FICO scores.
So yeah, thank you. And that's a huge thing. I guess what I'd love to be able to give to the viewers is how can the consumer find out without coming to me or whoever what the real actual, mortgage lender, FICO 4, 5, 3, whatever, how can they get that score?
Okay, so that score is a protected score, but my FICO has had to have a consumer self-disclosure. So they have a consumer self-disclosure site. It's called myfico.com. You can go there. You could pay $63. You could buy a one-time report. It will give you every FICO score for every industry. So it'll give you mortgage scores. It will give you auto loan scores. It will give you credit card scores, bank card scores. It will give you every version because there are different versions tilted towards different industries. So it'll give you every version. So, it's a huge, huge report. So the average person, if they pulled their report, it's going to be over 100 pages. It really breaks it down. It's a lot of information in there. It's really, it gives you almost too much information as opposed to the report that you have, which is nice and concise. But it really kind of spells it out and tries to educate the consumer. It is a little bit overwhelming, I'll admit. So when you see it and you're like, oh, just 100 pages of this report, but it does try to, at least try to educate people.
Well, thank you. So that's good to know. If you really want to do something in advance and you really want to be sure, that is how you can do it. You can go to that website and get all that information, and you have your real scores. Obviously, once you apply for a mortgage or whatever you're dealing with, if you come to us, we will just do a soft pull initially, which will be your real FICO scores that we're going to get on your actual report, but it does not count as an inquiry on your report, which everyone's worried about inquiries. Noel, why is everyone worried about credit inquiries? What effect does that have on a score?
Well, every inquiry does affect the score if you're applying for credit. So every time you apply for credit, it's considered what's called a hard pull, and a hard pull actually counts against your credit score. Now, the soft pulls, which would be if you did a soft pull for mortgage, or if you're just checking it yourself, if you went to the Credit Karma, the My FICO site or whatever, those are soft pulls. And you can pull your credit score in a soft pull every single day for the rest of your life. It's not going to count against a single point. So one of the telltale signs of somebody that's in trouble, because that's what FICO is trying to do, is predict, are you a risk? And one of the telltale signs is somebody that is searching for credit constantly. So if you have one inquiry, not really going to be a big deal. If you have a hard inquiry, if you have 3, 4, 10 in a month, well, guess what? What's going on? This person statistically tells them they're probably in trouble and trying to gain credit to maybe survive on.
So one of the things that we've heard a lot is, for not discriminating or not preventing people from shopping for the best deal. Isn't there some sort of rule out there that if the same type of lender pulls it within a certain period of time, they don't count as multiple inquiries? Can you explain how that works?
Yep, correct. So 100% correct there. It's actually, for mortgages, it's 45 days. So if you are shopping for a mortgage, if you went to a different mortgage professional and that mortgage professional pulled a hard inquiry for you, for 45 days, if you went one a day for 44 days, that would count as a single inquiry, okay? Because as you're allowed to shop around. Same thing it's supposed to be the same thing with auto loans, okay? The real key to this whole thing is when they're pulling it, they have to differentiate themselves as a mortgage puller or as an auto loan puller. So what happens a lot of times, you see it not working as much as you used to see it happening years ago with mortgage inquiries, is they aren't, if you go to, for instance, a bank, a major bank, and then the major bank pulls, well, they're not just pulling for auto loans, they're pulling for credit cards, they're pulling for, boat loans and stuff like that. So their inquiry, their polling system, the the trigger in there might not be saying, hey, this is an auto loan score, or this is a mortgage score, because it might be confusing. It doesn't happen a lot of times with the larger banks, but if you go to like a local credit union or something like that, you see it happen a lot because they do so many different loans.
Got it. Thank you. So that's really interesting because we always hear, hey, I don't want a credit pull, which, right at this point, we have the solution, which is we're just going to do a soft pull. Once you're ready to go and we know for sure you're 100%, then, yeah, we do have to do a hard pull, but then you're done with your shopping. There's nothing to worry about. But,
and one more thing regarding if you went to that FICO site, if you want to see or the consumer wanted to see where they are, usually around page 10 or 11 of that principal report, that will say most widely used in mortgage lending. So they can go there and they can see those scores, and those would be the same scores if they were to see the scores and like, oh, hey, I'm great, and they call hey, James, I'm great. My scores are a 716, a 732, and a 735. Those would be the exact scores if you pulled it right then and there with the same information. Now, the only thing is if somebody did actually, if the information, one of the creditors did update information in that time between they pulled it and you pulled it, then that score could change, but probably not going to change if you pulled it, right after that.
So that's a good point too. I want to just touch on that. So lots of times when we're running our simulators, which are obviously not perfect, but they're good, and we tell a person, hey, do this, 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 and this, pay this balance down to exactly this and this one to that, and you should get X for a score. It's the ones that take their sweet time doing that, could be 3 weeks later that they actually did what we said, and then we submit for a rapid update on our end, and guess what? The score didn't go up as much because balances or something else changed on their credit because so much time passed. It allowed for more things to change. So, I mean, what's your advice there when you're trying to do a rapid rescore?
Well, what I always say, if you're in the mortgage process, you have to be kind of fanatical about what you're doing with your credit. So, we usually say like below 10%. So don't let it get above 10%. So if you're, you have that $12,000, credit limit and you have to keep it under $1,200. Well, once it gets to $1,200, pay it back down to zero. Like you reset the clock. If that means you have to pay it twice a month, once a week, every other day, depending on how much you're using the card, just keep them in that sweet spot. Less than 10, above zero, be using the card, but at less than 10%. That's the way to kind of make sure that there's no surprises, because you might be paying down, your Discover card, but your Bank of America balance had gone up significantly in the meantime because you used that for business or whatever. So you have to pay attention to all of them, even if they're in a sweet spot or if they're reporting good information there. Make sure that they're all in that sweet spot, because they all report different times of the month, so those things could change. And just because you're paying Peter to robbing Peter to pay Paul, that's what could be happening, because your score might just not be an optimum spot.
So you mentioned earlier that Amex was different.
Yes.
Explain that to the viewers. How does Amex differ in terms of credit scores and usage?
So American Express, what they do is, because you have to pay that balance in full each month, you can't carry a balance from month to month. They have actually changed the way it reads. It's actually listed as, instead of an R, designation for revolving, it stands as an O for other. So what happens is it's an account. The balance there is not graded, just as your balances aren't graded on your auto loans, on your mortgage, or anything else. It's your balances are just the revolving accounts. So American Express falls outside of that 10% or below 50% level, because it's just not graded.
So that's a great tool then, because so really in essence, if somebody, let's say for their business or whatever, but it's in their personal name, of course. Obviously, business is separate, but if it's in their personal name and they use an Amex card and they carry a pretty high balance, even though they pay it every month, by the time the credit pulls, if that was a Bank of America credit card, they could be at 80% of the limit, where they're going to get hit with the credit. Whereas if this was an Amex and the balance was 80% of their limit at that time that it scored, that's going to have no effect on the score.
Yeah,
that's awesome.
Yeah, American Express does not have a limit. There are American Express where there are revolving accounts that do have limits, so that you could carry a balance. So it's important to know which one you have. Mm-hmm. If you have, basically, if you have a limit, you need to follow that principle of keeping the balances low. But but that doesn't mean don't get caught just having American Express only on your credit report, because there is a thing, if you don't have any revolving accounts, there's a little penalty that happens if you're not carrying any recent revolving balances. So make sure you still use those other cards.
Amazing. Let's see how fast this goes, Noel. Let's talk about that then. So for somebody, we have a lot of borrowers who we don't want credit. I just pay cash for everything.
Yep.
And then we pull their credit. They want to get a mortgage, and there's no scores.
Yep.
Now we have some unique programs where we can do alternate trades and things like that, but it's still a lot more difficult. And you're in an alternate program now, which isn't going to be the best. So for those that have no credit cards, have no debt, what is your advice to them to get decent enough credit scores so they're not no scores, NA. What would your advice be to them?
Okay, well, there's two different types of people that maybe don't have credit. There's the people that maybe you put everything in their business. Maybe they have a business and they put everything in their business credit, so their personal credit kind of withers away. And what happens then is they kind of look like they just graduated college, right? They have nothing on their credit report at all because they're so financially savvy that they don't pay interest or anything to anybody. So that's great. The problem is that your credit withers away. So you do have to carry something on your credit report, even if it's just something where you maybe you have a credit card that you got from whatever major bank that reports all three bureaus, and you put your Netflix bill on there, and it pays it automatic, set it for automatic pay. That's great, okay? As far as the people that maybe don't have, or maybe cash people and don't have any credit at all, the first thing you need to do is you need to start opening up at least one credit card. Ideally you want more, but start off with actually one. Get one on the report, okay? And then from there, it's about how, I always say this, I'm like, credit's like juggling. If I tell you I could juggle 3 tennis balls, who cares? But if I was here juggling 100 tennis balls, that'd be very impressive. So same thing, your credit. More accounts open, active, and paid on time, the better. So having get started with at least one credit card, maybe 2, and then also, maybe your wife has or your spouse has uses credit. If they added you on as an authorized user on some accounts, those accounts will appear on your credit report. Those will help you get, store credit cards and stuff like that. They will also appear on your credit report, that history all along, so it gives you a score right away. But one way or another, you need to have some accounts that are actually on your credit report.
So I was just going to ask you about that. That's awesome. Thank you. Authorized user accounts. So you just hit it there. Getting added to a spouse or whoever's account. Now, on the flip side of that too, we have some people that are, maybe that they have that on their credit, that it has a very high limit, a lot more than 75%, and it's hurting them.
Yep.
So what's the easiest way for someone to remove themselves as an authorized user from an account? How would a consumer go ahead and do that?
Well, you just call the credit card company and you ask them to remove you from the account. Call the number on the back, ask them to remove the account. The other thing too to do is probably reach out to the credit bureaus and tell them you want that account removed from your report because you're not on that account. So what happens a lot of times, you see it happen with maybe young people that when they went off to college and their parents gave them a credit card to use just for emergencies. So they have an authorized user account on there, which is great because it's going to help them build their credit score. On the flip side of that is that the parents carry a very high balance. It might be hurting them because they might be applying for a mortgage where their debt to income is going to be way out of whack because of that high balance on that card.
Awesome. Okay, and that brings up a good piece with children. So we hear a lot of stuff with kids and children that they're 18 and now they have all this crap on their credit. They don't know. They don't realize. Is there anything that you give advice to parents for their teenage kids and just preparing them for credit? I know that could be a whole extra podcast, but I'm just saying just some broad strokes perhaps.
Well, it's important, do teach them about credit. Do teach them, maybe you open an account with them if you're maybe instead of adding them on as an authorized user on one of their accounts, or maybe do that, but maybe open up, jointly with them a account in their name where they can actually learn about credit. Now, the flip side of that is, kids are young, kids make mistakes. So realize that if you do put them on the account or open an account jointly with them, that they will, if they make a mistake, it's going to be on your credit report. So it's a fine line, because do I want to help my kids out? Sure. But do I want my kids' mistakes to, appear on my credit report and damage my report? I mean, that's what you have to kind of weigh. So I would be careful with adding those things on there. I would definitely encourage them to get a credit card as soon as they possibly can, because let them make the mistakes when they're younger, because, hey, maybe they're not looking to buy a house until they're 26, 27. So maybe the mistake they made at 18, negative history stays on for 7 years, that will have passed a couple late payments when they're 18. It's not going to haunt them when they're 27.
Perfect. Next topic. This whole 7-year rule. So foreclosures, bankruptcies, late payments, collections, charge-offs, foreclosures, whatever. Can you give us, how does that work? And is it as far as how long things stay on, and what is that actual rule? And is it different between the three credit agencies?
Okay, so negative history stays on for 7 years. Okay, that means that any collection account that you have, or any late payment you have. So, for instance, if you have a late payment in September of 2024, okay, well, in August of 2021, that will come off your report. Okay. 31. When you're 31,
yeah,
what did I say? 21?
21, yeah.
Yeah. So
I like that. If we could turn back time, you're on to something.
Yeah. So in 31, that will come off the report. So, and that goes for a collection account. If you have a collection account that, started, 7 years, it comes off the report from when it happened. Now, bankruptcy, any of the accounts that are put through to bankruptcy, those come off in 7 years. However, the public record for bankruptcy, whether you filed it and you decided not to do it, was dismissed, or filed it, went through the bankruptcy and it was discharged, the actual public record portion of it will stay on your credit report for 10 years. So that 10 years is a long time, because it will, credit card companies, statistically, people that file bankruptcy, 9 times out of 10 haven't learned their lesson, so they're more apt to get themselves in trouble again. So they will be discriminated against for having that bankruptcy on their credit report. So you're not going to be getting the 0% offers on, car loans. You're not going to be able to get the 0% offers on the credit cards. It's all going to be the super high 25% interest rate on credit cards, because statistically you're going to, you're more apt to get yourself in trouble.
Awesome. Yeah. And just something for the viewers that are interested in mortgages. Bankruptcies and foreclosures, all of our loan program, every loan program has a waiting period where it has to have passed for a certain amount of years. And, we have some aggressive programs that will allow you to do something in as little as 2 years. We even have some really, really aggressive programs in less than a year. But traditional programs, I would say 4 years is kind of like the main goal. 7 is really where you're not going to run into any issues. But if you have a foreclosure or bankruptcy in your credit within the last few years, there may be something we can do now. So definitely don't hesitate to reach out and see what we can put together for you. Just wanted to comment on that piece. So, okay, we talked about the no scores and what to do. All right, one of the hot topics is repossessions. We actually just had a client that we had this discussion with that you're helping right now. You mentioned that you can possibly help somebody get a repossession removed. Do you want to talk about that a little bit,
Sure.
or that and some of these services that are unique? Why somebody would actually call the Kelly Group for help?
Yeah. So, there's a lot of different things that happen with, like, for instance, a repossession. So, and with anything that happens with your credit, stuff that happens with your credit, there are ways to kind of, maybe downplay it a little bit with your credit so it's not as impactful. Maybe there's ways that that there's mistakes made when it happened on the creditor's end, and just because the creditor says, "Hey, you were late," or the creditor says, "Hey, this repossession happened," that doesn't mean that it has to stay on your credit report. There's a lot of different ways that and rules that they have to follow to make sure that they are not violating your rights as a consumer. So, and especially like repossessions. Repossessions, there's a lot of different things that happen with a car purchase that's repossessed because you're dealing with initially the dealership that sold you the car. You're dealing with the lender that that actually, is you be making payments to. You're dealing with the repossession agent that actually came to get the car back, and you're finally dealing with the company that is resold the car. So a lot of people think that those repossessions on there, hey, it's a death sentence. It's not. There might be some things on there that can be done to, or some ways that we can look at to see, okay, maybe we can get it removed. Maybe, there's a balance due. Maybe you don't owe that balance. There's a lot of different rules and that go into it that maybe all four of those companies aren't following exactly, and maybe we can kind of leverage those things to help you improve your credit so that way you can qualify for a mortgage earlier or improve your score. So that's kind of what we do. I mean, we look at a person. What we do is we look at a person's credit report and how can we help you get a higher score? That's what we're looking at. Like a lot of our clients come to us because they need help with some issues maybe they had in the past. Also, a lot of clients stay with us because they want to make sure that they're moving, the right score. So we're constantly have clients that we look at their reports quarterly and just kind of, right the ship and point them right back in the right direction. Like, oh, you need to go this way, okay? And then the quarter comes and they're a little bit off again. We get you back on track again, and that's what we kind of do. Is we always helping people get the best score possible. So
nice.
Our advice, I always say, as I was using that analogy before of, kind of juggling 100 tennis balls and, having a lot of things open active. Well, a smart financial decision is just to pay cash for everything because you're not paying anybody else interest. But, our expertise lies in credit, so we're always trying to help people get the best credit score you possibly can. But you have to take what I say as a credit expert or, somebody that knows about credit and what's smart financially, and you have to kind of and what you want to, how you want to live your life, and kind of mold those things into how what's best for you.
I like that. So for the viewers out there, you can call Noel and the Kelly Group, and they can keep you on and monitor. If you're unsure of what you're doing, it might be a good thing if you're nervous about it or if you've had issues in the past and you just want to make sure you're staying on track. That is a service they offer. Noel, tell the viewers how they can reach out to you if they're looking for your help. What would be the best way for them to contact you?
Probably the easiest thing and the simplest thing for everybody is just look me up on LinkedIn. Noel Gill, Noel Gill, the Kelly Group, and reach out to us and we can certainly do a credit consultation for you and see what we can do to help you out. You can. If you have some issues or something like that, we can certainly see what's best for you, kind of discuss your situation, what's best for you and what can be done, because everybody's credit report's unique. So, the key thing is, whatever happens to your credit, whatever happened in the past, it doesn't mean that your 7 years you're just in purgatory. It's not. So, we can help you, obviously if you hit some really tough times, yeah, you're going to really tough times, but how do you come back the quickest? That's what we're always looking to do. How do you come back the quickest? How do you, qualify for a mortgage the quickest? How do you, able to get, credit cards again? How do you able to kind of get, pick yourself up and move yourself forward?
So Noel, the next thing I wanted to ask you about, because we get this all the time, are people getting a mortgage. We get their credit score. They're fine. We're good. We have a plan. And then, James, can I go buy a car? Can I go open up a Bob Stores account to go buy furniture? What can you talk about that? What effect does that have? How can those inquiries change the score? And also, to let the viewers know, lots of times we will do a soft pull throughout the process or at the end, purposely to make sure you didn't incur any new debt while we were going through this process, because we have to debt you for that at that point. But what effect does that have, Noel?
So yeah, the inquiry, as we mentioned before, those inquiries do mount up. So it seems kind of harmless, like, oh yeah, I'm closing on my house, on the 30th. It's going to take 6 weeks for me to get curtains or furniture or whatever it might be. So like, oh, if we go and get it, 4 weeks before, then we'll have to wait 2 weeks into the new house before we, get those things. So the trouble with that, the inquiry is going to hit you a little bit, right? So if you don't have too many inquiries, it's not going to be a big deal. But then if once the trade line reports your credit report, the trade line is another account that they're going to look at and they're going to say, whoa, hang on a second. Let's see if Joe Smith can handle paying this brand new trade line. And your score, any new trade line to your report, the credit score is going to drop for 6 months. And they're going to say, hang on, let's see if he can handle paying this account. And then after 6 months, your score is going to be better off for it. So it's equivalent to taking one step backwards to take 3 steps forward. So our advice always, the big ticket items, obviously the mortgage. You're not going to buy anything else in your life, that on your personal credit at least, that's going to be bigger than that mortgage. So what we say is, don't buy, keep paying everything on time, keep using your credit cards, use them minimally. And don't open up anything new. That means no furniture, no curtains, no auto loans. Like wait till after you close. When you close, if your lease is up, you maybe call the leasing company, ask them to extend your lease for another month or two till after you're closing on your mortgage. That way, once you leave the closing table and you've signed your life away, then you can go and get that new car loan or buy the furniture or whatever you need, because then the inquiry is not going to matter. Because as you said before, you're going to do that soft pull. Sometimes your lenders will do a pull just to make sure before funding the loan that there's nothing else there. So if that score drops, then guess what? I'm sure you could probably say you're not getting that same rate, right? You might not qualify for that mortgage anymore.
Yeah. That's definitely something that comes up at the last minute. We do try to prepare our borrowers on purchases. Hey, by the way, if you could help it, don't have anyone else run your credit for any other purpose because it's going to come up. But you brought up something earlier in the podcast that I wanted to ask you about. You mentioned that credit lines or HELOCs, whatever, $70,000 and above are not treated the same way as a credit card. Can you talk about how they are treated and how that affects your scores? Because that's something that I've always really been curious how that would specifically affect.
Sure. So years ago, a HELOC, whether it was for $240,000, was treated just as like a credit card account. So imagine having, and a lot of times those HELOCs, the full HELOC was used, whether you're doing like a blended mortgage or something like that back in the day. So it would be counted as a credit card. So when they're looking at your credit card scores, again, or your credit card balances or revolving balances, they're always looking at where you are in proportion to your credit limit, and they're looking at each account individually as well as them all as a whole. So imagine if you had 3 credit cards for $10,000 credit limits each that were great, but then you had a $240,000 HELOC that was at $240,000. So yeah, you're doing great on those 3 credit cards, but you're getting penalized big time on that one. So what they started doing is they started actually changing the way they categorized them on the credit reports, which then changed the way it was calculated towards the mortgages or towards the score, because then they're counted as a mortgage instead of just a revolving account.
So for clarification, if someone got a HELOC that was, say, $50,000, is that still going to be looked at as like a revolving credit card?
Most of the time, not really. Each lender is different, because what happened, the $70,000 rule is something that was maybe like an older account. Nowadays, they're pretty savvy in how they report those things because they are mortgage accounts, not. So, but don't get me wrong, there are lenders out there that still report them as a revolving account. So, I mean, the real key is look at your credit. You should be looking at your credit report anyway. So if you check your credit report, you can see, how it's reported if you have a small HELOC there. But if it's a new trade line, chances are it is reported as a mortgage. But sometimes you have to be careful, because I would check your report just to be sure.
Awesome. Good advice. I like that. So I guess that's something that we can always look at as well as when we're looking at consumers' credit, and we're trying to, again, we're not credit experts here at Forte Financial. We do look at credit reports regularly. We have given general advice, of course, been doing this as long as we have, but it's something we can certainly look at. But no, this has really been great. This has been very, very informative. There's so much we can sit here and talk about all day, but we've covered the broad strokes. We can certainly do something specific. Viewers, let us know what other areas of credit you'd like to get some information and more advice on, as you're preparing yourself. Just some basic things, viewers, as far as mortgages are concerned and credit scores. this doesn't necessarily have to do with Knoll, but I'll touch on this since we're talking about credit and we are a mortgage company. FHA loans are something we do a ton of that are wonderful because the minimum credit score is pretty low. Actually, there's a few different variations of how we do it, but a 580 credit score, which is not a very good credit score, is the minimum to get an FHA loan with maximum financing, which is 3.5% down. And so you can get an FHA loan at a very good interest rate with a 580 credit score with 3.5% down. So that is a type of loan you can get that is, if you are credit challenged, that you can do. Conventional, the floor on conventional is really 620, but even at a 620, first of all, the rate at a 620 on a conventional loan versus the rate at a 7, 20, 40, 60, 80 is dramatically different. There's thousands and thousands of dollars in fees that you're going to pay to get the same rate as someone in the 700s. So some of these steps that we've talked about in this podcast and preparing or perhaps hiring someone like the Kelly Group to monitor and help guide you, that cost will be significantly less than what you're going to pay in one loan for the difference. So some of those specialty loans we do. And now for our investors, for those of you buying real estate, a lot of our DSCR or no income documentation loans, you really need to have a pretty high credit score to get the best terms, where we're offering very aggressive rates and terms for those programs for our borrowers that are well into the 700s. So you really want to make sure you're up there and check in. Let's get you fixed, and we can make the introduction directly to Knoll for you if we see something that we think they can help you with. And Knoll will have a consultation with you and go over that and let you know what they can do to help and what that would cost. So is there anything you want to add, Knoll, or do you think we've covered?
No, I think one thing I'd say just to help you out is kind of plan with your credit ahead of time. So if if you're going to be looking for a mortgage, let's say, hey, I want to buy something in December. Well, then right now, 2 months before, that's where you really want to make sure that your credit's in line. So get those balances paid down so that way you're not waiting to do that. So it does take some time for that information to pass through to the credit bureaus. So plan ahead. 2 months ahead of time. Make sure you're looking at your report. get those balances down. Start being fanatical with those balances just to make sure everything's good. Make sure everything's paid on time. Make sure there's nothing outside. Open up all your mail so there's nothing that's going to slip on your report. Like the kid's dentist copay that you forgot to pay or something silly like that. So just make sure that that you're kind of just looking ahead a little bit and planning ahead a little bit, and that's going to help you out, make it smoother to get your mortgage with James.
Thank you. That brings up one last thing that's really important before we wrap up. Medical collections. The amount of borrowers that have perfect credit, everything paid on time, never had a late payment, they come in and then their credit score is in the 500s because of a stupid medical collection that they had no idea about. So obviously there's nothing we can do as far as helping them with something like that specifically to get removed. So obviously that would be a great referral to you, but is there anything you want to touch on for someone that might be in that situation and what the hell to do? Yeah.
Well, medical collections below $500 now are not supposed to be on the credit report. Might there still be something? The answer is yes. So medical collections, you're relying on once you pay those medical collections, they're supposed to come off the report. So just because they're supposed to doesn't mean that necessarily does. When you're dealing with collection agencies, there's some pretty interesting companies out there that are supposed to do things in a timely fashion and don't. So you have to be you have no idea who you're getting. So that's supposed to come off the report if it's less than $500. If it's more than $500, it's supposed to be put on your report. That's in flux though. It keeps changing. It used to be it was below $250. Then they moved it up to $500. There was talk about no medical collections on the report. It's still all over the place because what doctors have realized, it was easier for them to send anything kicked back from the insurance company to a collection agency to collect than hiring somebody internally to collect on it. So the problem is if they keep not letting medical collections on there, you're going to go to the dentist and you're going to be like, oh, I'm here for this. And you're like, no, you owe this other doctor, $1,500, and they're not going to. There's going to be a doctor network or something, because what happens to all that money? It's going to cost us somewhere. But as far as the actual on your report, they're not supposed to be on there less than $500. If it's more than $500, it's supposed to, as soon as you pay it. The collection agent is supposed to take steps to remedy to remove it from your report. But again, does that always happen? The answer is no.
Okay, so that's something that has happened a lot in the past. Is we'll have a borrower and I'll go over like, oh wow, are you aware that you have this collection, that collection? Not necessarily medical, but that included maybe a cell phone or a utility bill. We see that a lot. Somebody moves, it goes to the old address. They think it's paid off, and what happens is sometimes they'll go and pay it off to zero, and then all of a sudden their credit score drops.
Yeah.
So. And I know that lots of times we've said, oh, if you can get a deletion letter and make a deal. Can you talk a little bit about that and why someone, when they pay off a collection account, their score could drop immediately? When you go from having this big collection to zero balance, and now your score is worse. Can you explain why that could happen and what they can do to remove it like it never happened? Can we touch on that?
Sure. So as far as collections are concerned, anything that happens recent is going to pack, or with anything with your credit, anything that happens recently is going to pack a punch. So what happens is when you pay a collection account off, what happens is it might be a collection that's been on there for 2 years. And then all of a sudden you go and pay it off. And then what happens is the date of last activity is updated. And then when it goes to be scored, the score drops because the credit score is picking up as this just happened. So that's what you see the score drop. Now, as far as you paying it to, and the philosophy behind that is, again, if it's recent, that's where it packs a punch. So the credit score picks up as recent, and that's going to drop it. But the philosophy is they're trying to prevent people going from 5 years never paying any of their bills, pay them all, and miraculously have amazing credit scores, and then burn the next lender. So what they're trying to prevent is that from happening. So what happens is that recency being updated is going to drop the score. Now, if you have a strong profile, hey, maybe your score dropped from an 810 to a 720. But as we mentioned before, you want scores north of 760 to make sure you get the best rate possible. Yeah. So, just going and paying to zero, like, oh, no, I took care of it. Because a lot of people will say, oh, you know what, I had that cell phone bill, but they pissed me off, and I didn't want to have it. I want to pay those guys, but I'm just going to pay it off and think everything's going to be great. And what happens is they go and they pay that off. Again, they update that date of last activity, the score drops, and then they're wondering why, like, oh no, I paid it off, and thinking that's going to get removed. And that's just not the case. It's going to show up as a paid collection account.
So we've had people in the past, and I know this is much farther and few between than not, but we've had people negotiate with a collection company and get a deletion letter. The agreement is, hey, I'll pay this amount in full instead of settling for half the balance if you remove it and delete it like it ever happened from the report. And I've had some people with success with that. What's your experience and thoughts on that?
Yeah. Well, the credit bureaus don't want them doing it. They don't want them using the credit bureaus as a kind of their enforcer. So the credit bureaus are strictly tell them not to do that. So when you pay a collection account off, what's supposed to happen is it's supposed to show up as a paid collection account and it's supposed to stay on your report. Credit bureaus are in the business of reporting, negative information. So if everybody was paying their bills on time, the credit bureaus wouldn't exist. So they're trying to basically say like, oh, this person's more risky than that person. And that's the philosophy behind it. So, yeah, could it happen where you can go and negotiate that as an individual consumer? Yeah, there's a chance you could. But most of the time what they'll say is like, oh, yeah, we'll mark it as paid in full. And people will take, oh, yeah, that's good. That's not good. If it's going to be deleted, it has to be deleted. That's what's going to raise your score. Otherwise, maybe the solution might be to pay that, right at the closing. So that way the score doesn't have a chance to drop. If you're already able to get financing, and you want to close in the loan, maybe that might be the solution for them.
Okay. Awesome. Thank you. All right, guys, I think we covered enough today. Viewers, just comment. Let us know if there's any other topics you'd like to learn about. And perhaps I can convince Noel to get back out here for another round at some point in the future. But love to hear your feedback, thoughts. Hopefully this was helpful for some of you first-time buyers, existing homeowners, or just trying to learn more about credit in general in terms of anything else you're doing. So Noel, thank you so much. It's been a pleasure.
Yeah, thanks for having me.
Thank you all viewers. We'll see you soon.